Well, okay, spot gold is trading at $2,600 and change. Spot silver, I think, is at like $31 and change at the moment. Well, isn't that what they're worth? Do you really expect any kind of good price discovery from Wall Street? Because everything's been turned into a big trade. So let me show you how to determine how much gold and how much silver is its true value right now. We look at global debt because that's how money is created in this system. And this is fiat money versus sound money. They're both money. They're just the flip side of the coin. So with debt, which is how money's created currently, it's an unlimited amount, right? That's why every time there's a problem, central bankers go to their printing presses because they can. There are no limitations on that. Now, every time they do that, the purchasing power of the value of the currency goes down, but what do they care? They get to use it first when it has its most value. It's us, the public, that has to deal with everything else. But the global gold supply is finite. I don't care if they find a new discovery. Anytime anything is physical, there's going to be a limited amount of it. Anytime. So the fundamental value that I'm about to show you represents the true value of gold, the fundamental value of gold on a 1-to-1 cover ratio, which means that this is how much it's really worth. When they do that overnight reset, I can't tell you what the cover ratio is going to be at that time, and nor can I tell you what the fundamental value of the gold is going to be at that time, because it depends on the level of debt that they've grown. But let's just stay with current, so we're dealing with facts. And the global debt at 313 trillion, not counting all the derivatives or all the other wonky products and complex products that Wall Street creates from it. So that's 313 trillion. And the global gold supply is almost 70, well, let's see, hundreds, thousands, millions, 7.498 billion ounces. That's it. And that means that the current fundamental value, which you've heard me say, and I know it sounds crazy, is over almost $42,000 an ounce. And the fundamental value of silver is $2,000. This is how you know that it's so severely undervalued, because they're going to hide it until they can't. And we've seen this happen over and over, even currently, in a whole bunch of currencies that are dealing with hyperinflation. So all you need to do to determine the true value of an ounce of gold for its most important function, which is to hold your purchasing power intact, is divide the debt by the gold. And that's how you get that 42 grand. And silver, remember, okay, is historically, when they did this, this is a 20th of an ounce, this is a full ounce of silver. So at a 21-to-1 ratio, that's how you get over $2,000 right now for the true value of silver. So can you see how severely undervalued it is? It will go to its fundamental value. I can't tell you exactly when, but I can tell you that it's happened over 4,800 times, 100% of the time. It's the way they attempt to get your confidence back. But this data then helps determine how much silver and how much gold do I really need to accomplish my goals. We're going to look at silver first because this is such an interesting long-term chart. You always have to look long-term because you can see anything short-term. But long-term, what we've got are two huge cups, right? Silver currently has not concluded this cup. This is what I keep talking about, that, well, maybe it's not going to happen by the end of this year, but it's working on it and it's definitely happening. So it'll probably happen next year. But since this is a double cup, here's this one big cup, here's this next big cup. Once that breaks above that, can you see how silver is likely to go toward that $2,000? Because it works like a spring. I think I have a spring in here. I do. Works like a spring. And if you hold that spring down and you suppress it and you suppress it and you suppress it, when you remove your hand, it springs. In this case, if it breaks that top, it'll spring up. It's just what always happens. So this is a huge technical pattern, especially with two major cup formations. Are they showing you this? No, they're showing you short term. They don't want you to understand how to get into position to protect yourself. But this is why silver will absolutely go to its fundamental value once it crosses that line. And it's why you see in some currencies, or at first, that we could see that gold and silver ratio grow a bit more narrow. However, once we enter the hyperinflationary stage in earnest, we won't see that anymore. So the volume also, you can see how that is escalating. This is the volume of trading, right? It's become a huge trading instrument, and that's done with contracts. That's not really done with the physical metal itself. So how do you know this is a positive trend? What you see are higher and higher and higher lows. Here's a guarantee I can give you. If you keep getting higher and higher lows, you're going to get higher highs. It's not rocket science. It's just logic, and it always happens. We see cup formations here as well. Here's one, and we've recently had a breakout. So the long-term positive trend is escalating. It was slower here. It picked up steam here. It's picking up steam here, right? So the trend is getting faster and faster. We're going into a breakout. At the same time, that volume is escalating because even this volume over here is higher than the volume over there. But that's trading volume, right? We also know in the buying of the physical volume, that too is escalating. But this is what at this time guides those bullion prices, the kind that you can hold inside of an IRA, or even the kind of emergency gold, which I like the raw stuff for. Outside of the IRA, it's going to be guided by this market at this moment. That won't always be true. It hasn't always been true. But the premiums just get a lot wider, and we'll see that happening into the future because this is paper. They can create as much gold and silver that doesn't exist as they want to. But we all know that personally, I like these collectible coins, and this is by far the lion's share of my personal portfolio, though the raw gold is also part of my barterable portfolio, having a variety of sizes. But let's stay with the collectible coins. And I'm not talking about the very high expensive ones. I'm talking about this is the collectible market. This level that I'm showing you here, which is the level that I prefer because I'm not spending $15 million on one coin. And let's take a look at some dates and how this has unfolded, because I'm just looking at what is most likely to happen. And number one, these coins are held privately. You can't do them inside of an IRA. Okay, so be clear on that. That gives me a level of comfort because it is in the category of a collectible. And therefore, since I believe that we are likely, or we certainly could see another overt confiscation, all of this inflation, taxation, all of that are forms of confiscation. They just don't say it that way because then you know what they're doing. And we don't want them. We don't want the public to understand what we're doing. But let me walk you through this chart. So this is where this market started back in 1970, and the index so an index is a whole bunch of coins, a whole bunch of these, right, put together. And that index started at 1,000. You can see that once gold was legalized to hold again, that we had a huge spike. We did that in spot market too, but more so in this market because this is a finite market, especially since in 1986, they standardized the grading of these coins. Up until that point, if I were a dealer, I could look at this kind of go, oh, I think this is a mid-state 65 and sell it to you that way. And maybe it was really a mid-state 61. So the whole industry was standardized and it really took off. And then, of course, you have this huge drop down. So what I'm showing you over here in 94, that's when you had the bottom of that index at almost 47,000. This is the bottom dip right now. 2021 was the bottom that this index dipped to. It's higher than this one, though, as we can see, right? Higher and higher lows indicates a higher trend. And we have had a little breakout, but we still have not hit the peak that we did in 2008, right? So those premiums are going to grow if history is any guide, which it typically is, but these are severely undervalued. And my personal expectation is that, number one, we have to go and hit this top line, and we're on our way there. We're close to a second breakout. And then, well, we don't have anything until this one here. So these coins are most likely technically to go a lot higher because, as you can see, for this entire year, they've just gone up and up and up. We need that second breakout. We will get it. When we get it, I will let you know. But essentially, we're still severely undervalued from where the high was back in 89, right? Which was 181,000 to that index. Will it go there? My guess is yes, but I can't guarantee that. However, we are starting from a severely undervalued level, and there's no fever like gold fever. And especially if they do indeed do a covert or an overt confiscation, and now this is the only way that you can hold gold, what do you think are going to happen in terms of prices? And when we do that reset, what do you think is going to happen in terms of prices? It's going through the roof. And that's why you can then take those gains and convert it into those underlying income-producing assets when they are cheap.
Lynette Zang argues that current market prices for precious metals significantly undervalue their true fundamental worth. She presents a method for calculating what she considers the real value of gold and silver by comparing global debt to available supply. Using current global debt of $313 trillion and a global gold supply of 7.49 billion ounces, she calculates gold's fundamental value at approximately $42,000 per ounce versus current market price around $200. For silver, using a historical 20:1 ratio to gold, she estimates a fundamental value of over $2,000 per ounce versus current market price around $31. Her technical analysis highlights what she sees as bullish patterns in both metals, particularly noting double cup formations in silver charts and consistently higher lows in gold charts. She interprets these patterns as indicators of future price appreciation. Of particular interest is her discussion of collectible coins, which she personally favors in her portfolio. She tracks a coin index that started at 1,000 in 1970 and has shown significant historical peaks, including 181,000 in 1989. While currently at lower levels, she believes this market is severely undervalued and poised for growth. Zhang emphasizes the importance of physical ownership, particularly through collectible coins, as a hedge against potential future government confiscation of standard bullion. She views the current monetary system's ability to create unlimited fiat currency as fundamentally problematic, contrasting it with the finite supply of physical precious metals. Her core thesis is that precious metals will eventually be forced to return to their fundamental values during what she anticipates will be a future monetary reset, as she claims has happened over 4,800 times historically.